Okay, welcome once again and for the last time back to Accounting 101. In this video, we will be doing the assignments at the end of the chapter or chapter 13, our last and one of the easiest chapters in the textbook. So, review questions 1 through 11. So let's start off with number 1. What is a corporation? A corporation is a business organized under state law that is a separate legal entity, separate and distinct from its owners. 2. List 3 characteristics of a corporation. Well, I've got 6, I think, here. Number 1 is it's a separate legal entity. Number 2, it has one or more owners. A third is there is no personal liability on the part of the owners for the debts or liabilities of the corporation. The stockholder cannot bind the corporation to a contract, cannot act as an agent, as a partner or a proprietor can. It has an indefinite life, unlike a proprietorship or a partnership. It is a separate taxable entity. It files a tax return and pays taxes in its own name. A proprietorship and or partnerships file informational returns, and the information from there flows to the owner's personal return and is paid by the owner, the proprietor or the partners. It allows for allows for the ease of capital formation or accumulation, comparable to proprietorships or partnerships. Review question number 3. How does authorized stock differ from outstanding stock? Authorized is the maximum number of shares of stock that a corporation charter allows it to issue. Outstanding stock is the stock that has been issued and is in the hands of shareholders, issued and outstanding. 4. What are the 4 basic rights of stockholders? They can participate in management by voting for the board of directors. Secondly, they can receive a proportionate share of any dividend that is declared and paid. Thirdly, they receive a proportionate share of any of the assets remaining after the corporation pays its debts and liquidates. And fourthly, they maintain a proportionate ownership in the corporation when there's a new issue of stock via the preemptive right of first refusal to buy the number of shares in proportion to your ownership percentage of any new issue. Review question 6. How does preferred stock differ from common stock? As I said in the lecture discussion video, the word preferred is often misunderstood and can be a bit misleading. It doesn't mean that it is better than common stock. In some cases it is, in some cases it's inferior. But preferred stock, it gives the owner certain advantages over common stock. Usually when you get something, you have to give something up. It receives dividend preference over common shareholders. That's where the word preferred comes from, preference. It also receives assets before common shareholders in the case of a corporate liquidation. 6. What is par value? Par value is an arbitrary number assigned by the company to a share of stock at its incorporation. It's completely arbitrary. They just pick it out of the air. It can be any number they want it to be. Again, as I said in the lecture, they usually take a nice round whole number that is low in magnitude, $1. Could be a penny, it could be $5, $10, something that makes it easy to credit the common stock account when you issue stock and keep track of things. Review question 7. What are the 2 basic sources of stockholders' equity? Describe each source. Well, there is contributed or paid in capital. That is when the initial sale of stock occurs. The stockholder gets a certificate. The corporation gets money or other assets in exchange. The other source of funding or source of stockholders' equity is retained earnings. That equity that comes from profitable operation over the years. Paid-in capital represents the amount received from stockholders. Retained earnings is the equity that is earned from profitable operations. So two basic sources: contributed or paid-in capital and retained earnings, earned self-generated equity or capital. 8. What account is used to record the premium when issuing common stock? And that would be when it sells above par value. That is the new account we saw in Chapter 13 called Paid-in Capital in Excess of Par. It is an equity account. So we'll have a normal credit balance. Review question 9. If stock is issued for assets other than cash, describe the recording of this transaction. Well, you always credit the stock account for its par value. If you get assets other than cash, you use the fair value of the assets received or the fair value of the stock being issued, whichever is more clearly determinable. Review question 10. Boy, these are easy. What is treasury stock? What type of account is treasury stock? And what is the account's normal balance? Treasury stock is the name we use to refer to a corporation's shares of stock that it has repurchased from shareholders. Stock that has been issued and outstanding has been repurchased by the corporation itself. It is a contra equity account, and its normal balance would be a debit. It is a reduction of equity. Review question 11. Where and how is treasury stock reported on the balance sheet? Under retained earnings as a reduction to total stockholders' equity. The stockholders' equity section of the balance sheet, now that we're in Chapter 13, if there is preferred stock, that is shown first under stockholders' equity, along with its respective paid-in capital in excess of par, followed by common stock, followed by its respective paid-in capital in excess of par, followed by retained earnings. You subtotal that up to get total, or just subtotal that up, don't call it anything. And then you would reduce it by any treasury stock outstanding, and if you had any paid-in capital in excess of par from treasury stock transactions. Now, we didn't say to do 12, but I'm looking at 12, and boy, it's begging me to answer it. What is the effect on the accounting equation when cash dividends are declared? What is the effect on the accounting equation when cash dividends are paid? When they are declared, a current liability is increased, dividends payable, and stockholders' equity decreases. Yeah. Liabilities increased, the equity decreases because being the same. When the dividends are paid, there's a decrease in both assets and liability. So the asset cash, or whatever property the corporation is distributing in the form of a dividend, and the liability is satisfied. All right, that takes us over to short exercise 2, I believe. Let's see if I can get this thing to forward. And it's not responding very well. Come on, turn the page. Short exercise. It turned the page, but I'm not getting to the bottom of the page that I need to get at. And now it went down too far. Oh, this thing just doesn't like me, I guess. Short exercise 13-2, generalizing issuance of stock at par and a premium. Colorado Corporation has two classes of stock: common stock $3 par value and preferred stock $30 par value. Requirement number one, generalize Colorado's issuance of 4,500 shares of common stock that sold for $6 a share. Go down here. So we are going to be getting cash from the purchaser of calculators over there, but let's see. $6 times 4,400 shares would be $27,000. That's the cash coming in. Common stock, I was recorded at its par value. I'll put the calculation up here. $6 per share times 4,500 shares. Up on the first line there, I added $6 per share times 4,500 shares. SHS is the abbreviation for shares. Now, common stock. How many shares did we sell? 4,500 shares at a par value of $3 a share, which would be half of that, would be 13,500. And the balance, well, there's the credit to the common stock account, 1,300 or 13,500. The balance goes into the paid-in capital in excess of par account. $13,500. And again, you can look at that as the plug figure, or you say, hey, the $6 it sold for, market value, par is $3, the difference of $3, again, 4,500 shares times $3, another $13,500. Requirement 2, generalize Colorado's issuance of 4,500 shares of preferred stock for a total of $135,000. So they tell us here what it is. So the cash comes in at $135,000, and the preferred stock is credited at its par value. So we have $30 par value times 4,500 shares. So that would be $135,000. And finally, we have exercises 19 and 20. Turn the page. Exercises. Identifying advantages and disadvantages of a corporation, or using the corporate format for business. The following is a list of advantages and disadvantages of the corporate form of business. Identify each quality as either an advantage or a disadvantage. A, ownership and management are separated. That's a disadvantage. Well, of course, I guess you could argue the other way, but you would think that, see, that would give the possibility of having what we call a conflict of agency. Ownership should, management should reflect the wishes of ownership, but sometimes they'll do something contrary. The goal of a corporation is to maximize shareholder wealth, not necessarily make a profit. And they do that by pushing up the stock price, more or less, increasing cash flows. You get a management and you write they write their or have a say in how their compensation contract is worded, they may get bonuses if they hit certain benchmarks. Well, if you get close to those benchmarks, they're going to be looking at achieving those benchmarks, whether it benefits the corporation and owners or not. So you have a conflict, agency conflict there. They're acting in their own self-interest, not the self-interest of ownership. B, the entity has a continuous life. That would be an advantage of the corporate form of business. C, transfer of ownership is easy. That's an advantage. All you do is sell the stock between one person and another, or corporation. D, stockholders' liability is limited. That's an advantage. E, exposure to double taxation is evident. That's a disadvantage. The corporation files a tax return in its own name and pays taxes in its own name to the U.S. Department of Treasury's Internal Revenue Service division. Then, if it makes a dividend payment to shareholders, a share of the income they generated, that is taxed at the ownership level, at the shareholder level. So that income is taxed at the corporate level, and if distributed to the corporation, it's taxed at the ownership level. F, entity can raise more money than a partnership or a sole proprietorship. That would be an advantage. G, government regulation is expensive. That is a disadvantage. Okay. Come on. Oh, no, just trying to scroll. There we go. I don't know why the arrows work sometimes and sometimes they don't. Exercise 20, 13-20. Determining paid-in capital for a corporation. Aruba Corporation recently organized. The company issued common stock to an inventor in exchange for a patent with a market value of $57,000. In addition, Aruba received cash for 6,000 shares of its $10 par preferred stock at par value and 6,500 shares of its no par common stock at $20 per share. Without making journal entries, determine the total paid-in capital created by these transactions. Well, we don't do journal entries. We can do it as an abstract of the equity section of the balance sheet. So exercise 13-20. So we have the patent for common stock. Can't use par value because par value is an arbitrary number, but they tell us the patent is worth market value of 57,000. So we'll use that because it is more clearly determinable from the facts they give us. They don't tell us anything about the market value of the stock, so it's not determinable. Okay, and we received cash for 6,000 shares of its $10 par preferred stock. Well, you always record stock at its preferred or at its par value. Preferred stock, 6,000 shares times $10 par value. That would be 60,000. We don't know if it's sold in excess of par or not. Preferred stock at par value, 6,500 of its non-par at 20, and they don't tell us anything about whether that is above a stated value, no par value. So preferred stock, again, issued at no par common, it would be 6,500 shares. This is non-cap preferred stock, no par value. This is $10 par preferred. So not having any other information, we just take the 6,500 shares times the $20 that was given in exchange, and that's $130,000. Again, we have no information, so all we can do is take the information they give us. The common stock, we have the fair value of the patent, so we're going to use that. The preferred stock, we don't have any information other than its par value and the number of shares. That'll always be credited at its par value anyway. And the no par, we have $20 per share, so we can assume that that's the market value. And it would look like this. The total paid in capital from those 3 transactions would be $247,000. Again, very little information there. You have to just work with what is given. And that's what we did. Okay, that is it, other than the final exam, which will be sent out late. For the people viewing this that are face-to-face, it'll be in person on Tuesday, May 9th. And I'll give you the times for the morning class and the afternoon class. My online people, I will email it out to you and tell you when it is due. Okay, I had thought of toasting you all, and I will, but it's only water. I will probably have one later on. Have a nice little sip of bourbon from my reserve. Those of you who are old enough, once you finish the exam, or if you wait to get your grade, you can toast me and either praise me or cuss me under your breath. And those that aren't, you can have something to look forward to 2, 3, 4 years down the road. Thank you very much. I enjoyed teaching you, and good luck to all of you in your future endeavors, and may your dreams be the least of your accomplishments. And I'll toast to that sentiment. Okay, for the last time, goodbye.